Welcome to the Explainer. So, if you're learning accounting, running a small business, or maybe grinding through your CPA prep, I'm willing to bet you've hit an absolute brick wall when it comes to debits and credits, right? I mean, they can feel like this secret, totally backwards language that was designed specifically to confuse you. But listen, today I promise we're going to completely strip away all that dry academic jargon. We're going to make debits and credits feel totally intuitive, actually practical, and honestly, dare I say, easy. So let's just dive right into it.
Now, I want to kick things off by calling out the exact reason people get hopelessly confused right out of the gate. And it's this totally false assumption that a debit automatically means decrease, or that a credit means something good just happened. I mean, think about it. You look at your personal bank statement, you see a credit, and you're like, hey, awesome, I got paid, that's good. And a debit, well, that means money left your account. But here's the deal. In business accounting, that personal banking mindset will absolutely ruin your day. Debits are not necessarily bad, and credits are definitely not always good. Actually, they don't even inherently mean increase or decrease either.
So the most crucial thing we can do right now is just demystify the terminology. Debit and credit, which you'll usually see abbreviated as DR and CR, literally just translate to directions on a ledger. That is it. Debit simply means the left side of an account. Credit means the right side of an account. Just left and right. Think of them kind of like port and starboard on a ship. They are simply the directional tools we use to navigate a business's financial records.
All right, Section 1, the accounting equation. Let's look at the basic rules of the game. Okay, so if debits and credits are just our left and right directions, we obviously need a map to navigate on, right? You can't just steer left or right without knowing where you're actually going. And this brilliantly illustrates our map, the fundamental accounting equation: assets equal liabilities plus equity. You guys, this is the unbreakable physical law of the financial universe. Assets are basically the things a business owns or controls that have future value. Think cash or equipment. Liabilities are what the business owes to others, its debts. And equity, that's what's left over for the owners after you subtract those liabilities from the assets. And because this is an equation, it must always stay in perfect balance. If assets increase by $100, then the other side of the equation absolutely must increase by $100, or another asset has to decrease by 100. It just has to balance out.
Now here's that expanded equation, but now we're adding our left and right directions, our debits and credits, into the mix. Whenever a business transaction happens, we use what's called a double-entry accounting system. And all that really means is that every single transaction changes at least two different accounts. We use our debits, our lefts, and our credits, our rights, to adjust the different sides of this equation to make sure the scales never ever tip out of balance.
Moving on to Section 2, account balances. Let's check out how these left and right rules actually work.
So we know the equation, and we know our directions. Now let's see how different types of accounts actually behave under this left/right system. Because while a debit always means left, what actually happens when you apply it completely depends on the specific account. Behold the ultimate cheat sheet. Honestly, you might want to screenshot this one. Every account has what accountants call a normal balance, which is just the side that increases it. Looking at this chart, you can clearly see that assets naturally increase with a debit, meaning on the left side. Expenses and owner withdrawals also increase with a debit. But on the flip side of that, liabilities, equity, and revenue all increase with a credit, over on the right side. So if you want to add cash to your business, you debit your asset account. If you want to add a new bank loan to your books, you credit your liability account. The whole game is just about knowing which side makes a specific account go up.
All right, Section 3, real-life journal entries. Let's get some real-life practice.
Okay, enough theory. Let's shift away from these textbook concepts and put this into actual practice. I want you to see how these directional rules apply to real-world business scenarios, using what accountants call journal entries. Let's look at our very first example here. John is starting a business, and he invests $10,000 of his own cash. So, how do we record this? Well, step 1. The business just got cash. Cash is an asset. And from our trusty cheat sheet, we know assets increase with a debit. So we debit cash for $10,000 on the left. But remember our unbreakable law. We need double entry accounting so we stay balanced. Step 2. Where did that money actually come from? The owner. So owner's equity also increases. And how do we increase equity? With a credit. So we credit owner's capital for $10,000 on the right. And boom, our left side equals our right side. The equation is perfectly balanced.
Here's another incredibly common real-life journal entry. Let's say a business called A&J Garage Door purchases $800 worth of inventory. But they don't pay cash right away, they buy it on account, which basically just means they promise to pay for it later. First up, their inventory goes up. Inventory is an asset, so we debit inventory for $800 on the left side. Second, they now owe money. A debt is a liability. Looking at our rules, liabilities increase with a credit, so we credit accounts payable for $800 on the right side. We've added an asset on the left and added a liability on the right, beautifully balanced once again.
Section 4. Beginner mistakes. Let's talk about some of the most common pitfalls. First off, I want to completely reassure you, absolutely everyone makes mistakes when they're first learning this. Even seasoned pros slip up from time to time. So let's troubleshoot the absolute most common pitfalls that can throw your financial map entirely off course. One of the absolute most frequent errors is the reversed entry. This happens when you accidentally put the debit exactly where the credit should be, and vice versa. For example, if you pay cash for some equipment, you should debit equipment and credit cash. If you reverse it though, debiting cash and crediting equipment, here's the crazy part. Your books will still mathematically balance. That makes it a super tricky error to catch. But your reality is totally distorted. Your books will basically say you sold equipment and received cash, when the exact opposite is what actually happened. Here are a couple of other major pitfalls you've got to watch out for. First is recording a debit or credit into the totally wrong account. If you buy a company laptop and you debit office supplies instead of equipment, your numbers will balance, sure, but your financial reports are straight up lying to you. Also, missing the source document is a huge issue. Every single entry should trace back to a real physical receipt, invoice, or bank statement. And I really have to warn you here, even if you use fancy modern accounting software like QuickBooks or Xero, accidentally recording a debit or credit backward or into the wrong account will still completely throw off your entire financial map. The software is smart, but it only knows what you tell it.
And finally, Section 5. Quick recap and next steps.
Let's bring the energy up for a rapid-fire summary. You've navigated the tricky waters of debits and credits, and here are your foundational takeaways. Number 1, forget absolutely everything you thought you knew about debits and credits from your personal bank account. Debit simply means left, credit simply means right. Number 2, the accounting equation, assets equal liabilities plus equity, is the unbreakable law. Everything builds around that. And number 3, every transaction requires double entry accounting to ensure the left side and the right side stay perfectly in balance. The secret is, you no longer have to memorize arbitrary textbook rules, you just have to follow this incredibly simple directional logic.
Now, understanding the theory is great and all, but getting your hands dirty is where the real learning actually happens. I highly encourage you to apply this intuitive understanding immediately. Grab the free practice sheet linked below and practice writing out a few journal entries yourself. Honestly, the absolute best way to make this stick is to just actually do it.
Before we wrap up, I want to leave you with a little thought exercise to test your new grasp of the accounting equation. Imagine a business buys $50,000 worth of heavy machinery, and they pay for it entirely by taking out a brand new bank loan. Think about it. Which specific accounts are affected here? Which one gets the left side debit, and which one gets the right side credit? Think about how those scales tip and how they ultimately stay balanced. Keep mapping out those transactions, and you'll be a master of the ledger in literally no time. Thanks so much for joining me on this explainer, and keep learning.